You know things are bad when the first time you hear of a bank is when it collapses. As many of you probably know now, Silicon Valley Bank has been shut down by regulators. To put the bank into perspective, it's only around a fifth smaller than ANZ Bank here in Australia. It's got around $300 billion of assets, and it's a really big bank in size with a lot of customers. But this story isn't about bad loans or a scam crypto exchange. No, this is what we call a bank run, and I'll explain exactly how we got here. At the end of 2022, Silicon Valley Bank had $173.1 billion of deposits, and they'll soon become the largest bank to collapse since the 2008 global financial crisis. They had $8.3 billion worth of loans secured by mortgages, $138 billion worth of home equity credit lines, and $2.6 billion in commercial loan. That there just represents 15% of the total loans that they have. Here's what went sour. With COVID-19 came an era for technology companies to continue their rapid growth as consumers spent more to new and established tech companies. Many of these companies used Silicon Valley Bank in particular to hold this money for them. According to their own website, they bank nearly half of the US venture-backed technology companies, so they're a really big player in the venture capital space. As banks do, they invested this money in different areas for a return, whether that be in mortgages itself, different financial areas such as stocks or bonds, etc. Because the banks was getting so much money in deposits, they couldn't lend it out fast enough. So what they did was they heavily invested in long-term US government bonds, including ones backed by mortgages. These were quite safe at the time and had good value, as we had low interest rates around the world with nothing that much looking to change. If they held these for 10 plus years, they could guarantee a profit. However, inflation started to go up significantly, and to combat this, central banks around the world started increasing interest rates, and they increased them both rapidly and unexpectedly. These US government bonds that I was talking about, they have an inverse relationship with interest rates. So when interest rates start climbing, these government bonds prices fell. The main clients Silicon Valley Bank had were very concentrated depositors who were struggling with the interest rate rises and the high inflation. When they started withdrawing their money, the bank needed funds to give them, so they needed to sell some of their investments, such as these government bonds. With that, they had to take a pretty big loss to be able to do this. Credit rating agency Moody's also downgraded the bank's rating from this. A credit rating agency looks at different companies and rates them on their ability to repay back a loan. All you need to remember is the higher the rating, the better. So when someone like Moody's downgrades a big company like Silicon Valley Bank, markets listen, and that they did here. Although looking like they were getting desperate, Silicon Valley Bank then sold $2.25 billion of shares to raise money. Now, two things can happen here. Investors can go, wow, what a great deal. I'm confident they'll figure it out, get back on track, and I'll make money. Or, wow, they're panicking and they're screwed. Yeah, I'm out. Oh, the latter happened here, if you haven't guessed already. Last Thursday, clients pulled out $42 billion in just one day, which was around a quarter of all the deposits that they had. They tried to find another company to buy Silicon Valley Bank, but regulators shut that down, and just like that, it was all over. The story isn't finished here though. We're only the first week to it, and there's probably more that's going to unfold.